Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Akeso Inc. Annual Report. Akeso Inc. is a biopharmaceutical company that specializes in the research, development, manufacture, and commercialization of antibody drugs worldwide. The company has developed several products across various therapeutic areas, including oncology and immunology. In the field of oncology, Akeso's pipeline includes Akeso 104, a PD-1/CTL-4 bispecific antibody for treating multiple types of cancer, such as cervical, gastric, lung, liver, and esophageal cancer. The company is also developing Akeso 112, a PD-1/VEGF bispecific antibody to treat various cancers, including lung, biliary tract, head and neck squamous cell carcinoma, breast, colorectal, and pancreatic cancer. In addition to its oncology portfolio, Akeso has developed products for immunological disorders. These include Akeso 102, a PCS9 monoclonal antibody to treat hypercholesterolemia and mixed hyperlipidemia. Akeso 101, an IL-12/IL-23 monoclonal antibody to treat moderate to severe psoriasis and ulcerative colitis. Akeso 111, an IL-17 monoclonal antibody to treat moderate to severe psoriasis and ankylosing spondylitis, and Akeso 120, an IL-4R monoclonal antibody to treat moderate to severe atopic dermatitis. Akeso also has a preclinical product, Akeso 120, which is being evaluated for the treatment of moderate to severe atopic dermatitis. Furthermore, the company has collaborations with other pharmaceutical companies, such as Inovio Pharmaceuticals, Inc., to evaluate new treatments for glioblastoma, GBM. Overall, Akeso's diverse pipeline reflects its commitment to developing innovative antibody drugs across various therapeutic areas, including oncology and immunology. Akeso Inc. maintains a market capitalization of $116 billion, broadly in line with the industry peer group. Akeso Inc. trades at a higher price-to-book ratio of 15.56 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company maintains a moderate leverage profile, with liabilities making up 47% of total assets, suggesting a balanced approach between risk management and capital efficiency. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth for a company can be attributed to several key factors. The inclusion of 2 global first-in-class bispecific antibodies in the National Reimbursement Drug List, NRDL, has significantly contributed to revenue growth. Additionally, new commercial launches and the successful launch of products such as Chinese letter, ebronucimab, and Chinese letter, ebdarokimab, have also driven revenue growth. The company's deep penetration into hospital access and broad coverage of medical institutions has further boosted revenue. Strategic alliances with pharmaceutical companies, milestone payments, and license fees have also contributed to the increase in revenue. Furthermore, the approval of new indications and accelerated market access for subsequent indications have enabled the company to expand its market share. On the other hand, the primary drivers of revenue decline include a decrease in license income due to an amendment to the licensing agreement between the company and Summit. Additionally, sales of products decreased by RMB 45,005, while product sales recognized from performance obligations satisfied in previous periods increased by RMB 22,937. The decline in revenue can also be attributed to a significant drop in sales in other regions, down 78% from 2024. The company's financial performance indicates a significant issue with its ability to generate positive operating cash flow. According to the provided data, the net cash flows used in operating activities for 2 consecutive periods were substantial, totaling $1,475,243. This negative trend suggests that the company is struggling to cover its operational expenses, resulting in a depletion of its available funds. The company's financial situation has undergone significant changes in terms of debt levels and interest expenses. In terms of debt level, the company has seen a substantial increase in short-term debt, rising from no data to RMB 585.7 million. This indicates a notable shift in the company's liquidity management. On the other hand, long-term debt remained relatively stable at RMB 3,954.9 million. However, interest-bearing bank and other borrowings have increased by 9.2% and 16.3%, respectively. The increase in short-term debt suggests that the company may be taking on more financial obligations to meet its immediate needs. The stability of long-term debt is a positive sign, indicating that the company's long-term financing strategy remains intact. Nevertheless, the rising interest-bearing bank and other borrowings indicate an increased reliance on external funding sources. In terms of interest expenses, there has been a significant increase from RMB 68.3 million to RMB 131 million. This indicates that the company is paying more in interest payments, which may be due to the increased debt levels or changes in interest rates. Overall, these changes suggest that the company's financial situation is becoming increasingly complex and potentially riskier. Management is optimistic about the company's future prospects, citing significant progress in its key initiatives. The development of a new drug platform and the expansion of ag production facilities are proceeding as planned, demonstrating the company's commitment to innovation and growth. Furthermore, the establishment of additional R&D centers in Shanghai and Guangzhou will further enhance the company's research capabilities and drive future success. That concludes the financial summary for Akeso Inc. Feel free to comment below, and I will be happy to answer them when possible.